What's going on, you guys? My name is Kyle. I'm a full-time trader and founder of Opinicus. In this clip, we're going to be playing back a recent question that I got in a Trading Mentorship Group session where Benny was asking me about how I incorporate higher time frame analysis into essentially my intraday trades. Now, one of the key things I touch on in this clip is how you can really avoid catching a falling knife by using a higher time frame analysis. Anytime we have some type of trend day move, a big trend day move, and you're wanting to fade that trend day, this is a recipe for most traders for losses, right? For repeat losses, trying to fade some big directional move. Now, you can avoid that entirely by looking at the higher time frames. Let's jump into the question in the next clip.
I actually have a quick question about that, the higher time frame setups, right? So let's say we're looking at the 15 minute
Yeah.
and it's forming a hammer, and then on the lower time frame, obviously like the 2, 1, 30-second, is that at a level of interest and you've seen a A plus setup, will you rather wait for that 15-minute candle to close?
That's a really good question. So it depends entirely on the context of the day. So if price is showing some type of structural breakdown, meaning like say this key support on NQ is breaking, and then we're coming into some of those lower areas of support, I won't buy like a 30-second hammer in that scenario. I'll wait for the 15-minute hammer and probably give up, a bunch of upside just for that extra confirmation. But if we're in like a range near the lower part of the range, or we're in that uptrend, then I don't need to wait for that 15-minute candle closure. Where the 15-minute and those 30-minute really help is when price actually makes like a big break lower or is rejecting some big area. Like essentially if you found yourself on last Friday, on the backside of this move with some losses, this is probably an indication that there was a lack of understanding of the higher time frame setup. If you find yourself on big down days, right, or some type of structural breakdown, and you're constantly trying to get long on a trend day lower, it's a good indication that there's something missing from your understanding of the higher time frames. And so it's always much easier when the market is pushing higher constantly, because we're just looking to buy support. It's on those down days, those red days, or those big rejection times where people realize that, oh man, I have some deficiency in my approach here. That's kind of when you can really get a sense of your understanding of the higher time frame setups, because that's where the selectivity really makes a big difference.